Hey, it's Dennis TheLaptopTrader here with you, and today I wanted to talk to you a little bit about algorithmic trading and what it means for retail traders, and just in general widen our horizon of what algorithmic trading is all about, really, okay? So let's get into it. Sometimes algorithmic trading is given a bad name by a few losing traders that have experienced, a bad run of luck, to be honest, and it could well have been the problem of our own trading faults, or the way some of the algos might have been programmed, and something that could have been prevented by ourselves and not the algos themselves, because all they're doing is just playing out what they've been programmed to do, really. They've been about for decades, really, and they've always been present within the marketplace ever since mankind can automate and make life easier for themselves. And so it's not that they have just appeared out of nowhere and have started to gun for your stop losses, which is an excuse that I hear quite often. Now, to understand the side of algorithmic trading, we really must differentiate the different types of algos out there, which are the trading algos and the liquidity algos, which are liquidity providers basically for the markets. And whether we distinguish them to be good or bad, we have to take a perspective of one side of the traders. And for this purposes of this video, I will take the perspective of retail traders and what that means for us. Okay, so back to our favorite tool, Paint. Let's have a look at what different types of algos have an effect on the usual retail FX trader. Alright, so first and foremost, let's distinguish the difference between these two types of algos. There is the trading algo and liquidity providing algo. They both have a different end goal. The trading algo's goal is solely to make profit. However, the liquidity providing goal of an algo is to break even. Yes, break even. Now we'll get into why that is in just a moment, okay? Now, if we think about the biggest or the largest traded currency pair with the most amount of algos running on it, which is the euro dollar, and it has specific reasons for that, then let's just think about what these trading algos are doing. They're just trying to make profit. They've been scripted to make profit. Now, the question then arises, do they have enough buying power to move the market and then benefit from it? Well, if we think about the 1992 case with the Bank of England, ERM, and George Soros, then, I think it was something around £1 billion was spent by the Bank of England to buy up pounds to create the demand, and even then they weren't able to increase the pound's value that much. So it really begs the question of how big an institution has to be to move this trillion dollar market and then benefit from it. Okay, so it really needs to be a collaborative move for a market to move in favor and you to push the market in your direction, I believe. So for me, I don't think the trading algos will have an effect on the average trader within the FX market. Yes, of course, they're going to be trying to use those sweet spots within the market where there's going to be a massive amount of supply and demand, but and you might well be taken out a few times with your stop loss, and then you just see the price action go in your favor, in your initial favor. But that's part of the game. You just got to know where those sweet spots are. You got to be one step ahead of the game. And it's just about experience as well, really. You'll start to see where and when they are applied. Now, the liquidity providing algos, I did mention that their goal was to break even. So what exactly are they? Now, these are huge factory warehouses of just supercomputers, the size of football stadiums or soccer if you're watching in America. And they are massive. These things are trading on milliseconds, on even smaller time frames. Okay. Now, what that does is, if that algorithm or that huge warehouse is trading on a specific exchange, what that is doing is providing liquidity to that exchange, right? So there's a lot more people that want to get in and out of the market, and they are simply providing a service for those traders to be in and out of the market at a quicker pace and a smaller commission because of the increased in liquidity. Now, in exchange for that, because this sort of service attracts a lot more participants to the exchange, because liquidity is very vital when you're trading, then the exchange in return will pay the liquidity providers a rebate, and that's just a fixed sum of cash every month, or however they've contracted themselves. And so if those liquidity providing algos are able to break even on most of their trades, then all they're doing is basically just working for the rebate, right? So you can see what I'm trying to get to is that these sorts of liquidity providing algorithms are really there just to break even. They're not even there to move the market. They're just in and out, in and out, in and out. So for us, for the FX traders, I think this is a huge plus, because they're just simply helping us get in and out of the market much quicker. And of course, this differs whether you're trading on an ECN account or you're trading on the spot market, and it depends what sort of broker you have, and all those sorts of things. But in the grand scheme of things, there's a big benefit to these algos helping the FX retail trader, and which we're going to go into and summarize in just a second. So to summarize the advantages to the retail FX trader, I just wanted to say that because of the increased liquidity within the markets, we have better spreads. Nowadays you can get a spread of like a pip or under a pip, fractional pips. I'm normally getting about 0.3 pips spread on a euro dollar, which is fantastic. Also, you're able to get quicker execution, so you're in and out of the market. You don't have to be waiting. Once you've clicked, then you're waiting a second. It's instantaneous mostly, and if it's not, then go find a better broker. But lastly, and most importantly, is the ability to trade from home. If it wasn't for these algos providing the huge amount of liquidity that they do for the brokers, and in return the brokers provide a service to you to be able to trade, then we wouldn't be able to trade from home. We wouldn't be able to trade from anywhere that you have an internet connection, from your Starbucks or Costa or whatever. So I just wanted to bring this video so that you have another view of algorithmic trading, and not just have the cynical view that they always gun for your stop losses. It's very important to understand the differences between the stock and the FX market effects of these algorithmic trading. Okay, so hopefully you've enjoyed it, and I shall see you in the next video. So if you liked this video, click the subscribe button or watch the other videos.